One of the main things you will be reporting on your financial document is revenue. Revenue is the money that your company has received, and at this time, you will incorporate any discount you allowed and any products that were refunded on per return as damaged or not preferred. But the most common method to calculate revenue is to multiply the quantity of items you sold by the price at which you sold them, and you will use the same calculation even if this includes services. And the main reason revenue is called the top line is because it is reported first on the income statement part of the financial report. But when you subtract your expenses from the revenue, you get the net income or the bottom line. And there are a couple of kinds of accounting methods used to calculate revenue. One is cash accounting. Cash accounting considers those transactions where the items have already been paid for to be revenue. Whereas method 2, accrual accounting, counts all transactions, even the ones made on credit, as viable revenue, even though they don't have the money yet. Depending on the type of business you are running and the kind of accounting method you use, it could make a big difference when investors look at your financial report to see if the company is healthy. Now let's get into expenses.